Your business owner still using the same strategies from a few years ago, in 2026, you're probably not going to get the same approval. Here is why. Banks have become more strict with how much they're lending out, and they're more stringent with the requirements. In this video, I'm going to be going over what has changed in the funding space, how lenders and institutions are tightening up, and how entrepreneurs like yourself can still go ahead and get business funding. All right, ladies and gentlemen. All right, so now we're gonna break down what's going on in the funding space, why you might have feel like you have been qualified and you're still getting denied, right? Why in 2026 is it so hard to get access to capital, right? It's not that it's difficult to get access to capital. I just want to be clear with you guys. It's that funding rules and regulations have sort of shifted, right? Banks are more stringent with how they're giving funding out. And in this video, like I said, I'm going to break down why that is and what's going on and how you guys could still get access to funding, right? Because you may be like, yo, Zach, like I qualify. I meet all the requirements you're telling me about, right? I have a good credit profile, right? I got relationships, but I'm still getting denied. Can you help me, right? So this video is for you, my friend. Like, I know it's been a stressful time, but what's going to happen is I'm going to help you guys to be able to continue to get access to funding even in 2026, despite these changes. Because the reason why banks are more stringent now is because they want to mitigate risk, right? Because if so many people are defaulting, the banks don't really make any money, right? They want to still be able to make money. And how they do that is by borrowing to the right prototype, right? They need to borrow to the right type of person. And they just want to make sure you're the right type of person before they lend to you. But let me talk to you guys about what has been happening since COVID and why banks are doing this, right? So during COVID, right, at 2020, 2021, banks was basically giving everybody capital, right? So if you can see here, they were funding multiple business credit card, PPP loans, right? They were, you know, that era where everybody was getting a PPP loan. They was also doing MCAs, which is short for merchant cash advance, and personal loans, right? For a while, almost everyone looked like a borrower to the banks, like they weren't really stressing it, right? But then what started to happen, right? Beginning of 2022, the Federal Reserve rapidly increased interest rates to fight inflation, right? Because if inflation is too high, then people are not going to be able to afford things, right? If inflation keeps going up and you're still making the same amount of income, everybody's not going to be able to afford anything. So what they did to stop this, what happened as a result to this actually is higher monthly businesses that were profitable were when borrowing costs were low suddenly face. So businesses started to face this issue, right? So businesses started to face an issue, right? Before borrowing costs were low, they were profitable, right? But now all of a sudden, now they have higher monthly payments, increased operational expenses, reduced consumer spending, right? So consumers were spending less, more expensive inventory, and higher pay costs. So now businesses are struggling, and that impacted their ability to just pay back their debt that they were borrowing, right? Many companies that could comfortably service the debt in 2021 could no longer do it in 2023 and 2025, right? And then there was also the Instagram gurus talking about business funding and talking about all the hacks that you could do to get business funding. I'm sure you might have heard, oh, get funding even with bad credit, or you might have heard get funding without showing no doc, right? Because of all of that and everyone just going out and applying that didn't really have no business applying, that also added fuel to the fire, so to speak, right? So too many businesses became over leveraged, right? Some people were doing lifestyle spending, cars, vacation, personal expenses, covering operational losses and paying off robbing Peter to pay Paul, right? So over time, they started to get defaults, right? Debt only work if it creates more cash flow than cost, right? So we know this, right? If you can use debt and create more cash flow, is good. But if you're robbing Peter to pay Paul, you're not gonna be able to really win off of this, right? So let's continue. So revenue slowed with expenses staying high, like I explained, and MCA's advances exploded, right? Because these business owners were making revenue, but they weren't really profitable. MCA's took this as an opportunity to create products that could help these business owners. But with the interest rates of MCA's, it's almost damn near impossible for people to be able to become successful after an MCA loan. And this is no knock to MCAs. It has its place for certain business owners, but that's when MCAs started to explode, right? And then also on top of that, fraud increased dramatically. So during and after COVID, lenders experiences fake businesses, right? Inflated revenue, right? Synthetic identities, right? So a lot of people started committing fraud, stolen EINs, and identity theft, right? And those losses showed banks, they had a history of them. They now had like paper history on all of these losses, and it created a problem for the banks because they started to lose money. All right, so then they became more strict. Why do you need the money? Can your cash flow support the repayment? Are your deposits consistent, and are you profitable? So these is what the banks were asking post-COVID era, 2021. They started to ask this more prominently, and going all the way up to 2026, to where now everybody that is starting to get into funding now today is experiencing it. Right? So what this means for business owners in 2026. All right. So I just want to preface this by saying, yes, money is still available if you're a business owner and you're looking for capital, right? Money is still available. This is what you need. So if you're looking to get approved today, this is what you're going to need. You're going to need, and I explain this a lot in my Instagram and podcasts that I get on. So you're going to need a 700 plus credit score. Ideally, you're going to need strong monthly revenue, right? If you don't have revenue, if you're a new business owner, yes, you can still go out there and get funding, but you're going to have to be very strategic with how you're going about and getting funding, right? There's still banks that's doing non-doc, but you got to be able to leverage local credit unions, right? So what I would do if I were you was I would leverage local credit unions and build relationships with them. What that looks like is essentially going to the banks and finding a relationship manager. Now more than ever, relationship managers are important because they're going to be sort of the person on the side rooting for you and talking to the underwriter and telling them, hey, listen, we got to fund this person. We have to approve this person for a high limit. I trust it's been basically vouching for you, right? So I would say relationship managers are extremely important today more than ever, right? Along with the 700 plus credit score, along with the healthy business bank statements. If you don't have business bank statements, you're good. But along with the healthy credit profile, the 700 plus credit profile, comparable credit limits, right? So you have multiple credit cards with 10, 20, even 30K limits, right? You have that history on your credit, right? You have examples of you being able to borrow debt and pay it off for a long period of time, 2 years plus, right? Once you have those, you have revolving credit, right? You have different types of credit, right? Once you have those, now the bank is going to be like, okay, well, this person is someone that we could potentially lend to, right? Along with having multiple products with the banks that you want funding from. Because if you have multiple products with them, it'll be more likely that they'll want to lend to you, right? Those relying on credit stacking or using debt to survive rather than grow are more likely to run into trouble, right? So make sure your business is starting to be profitable, right? Create some boots on the ground opportunities. What I mean by that is try to create revenue without spending as much money in your business, and that could help as well. All right. Yeah. So like we already went over, what changed in 2026? Banks started to essentially tighten up. Small banks became more valuable, right? Like I stated. So if you're looking to get funding in 2026, I would say go to the small banks, develop that rapport with them, because they're going to be the ones that's more likely to approve you. The major banks, everybody's applying to them. And I say this over and over again. Everybody's applying to them, and they're a lot more strict with their lending now. Even Chase, where it was giving out people 50, hundreds of thousands of dollars in capital, and now they're approving people at a lower rate, and they're approving people for less because they want to mitigate their risk. They understand that they're one of the best lenders in the space, but at the same time, they don't want to lose money. So that's why they're approving people. And then once you're able to show that you could be able to borrow debt and pay it off, of course, Chase doesn't mind lending to you because that's how they get paid. They're in partnership with you as well. All right. So yeah, we went over these points. So if you guys are in the market for getting funding, just make sure you have a 700 plus credit score, 720 to 740 preferably. Utilizations under 10%. You have no recent late payments, no collections, no charge-off. 5 to 8 primaries. I would say 8 primary accounts with comparable credit. You also want to make sure your business looks fundable, right? So you have your LLC created correctly. You have your EIN. You have your business bank account. You have a professional email, and you have a clean website that banks could be able to refer to, right? And I would highly recommend, like I said, building bank relationships by depositing funds into the account and showing proof of revenue, right? And cash flow, right? If you can show that to the banks, you are golden, right? That's ideal, right? So even if you're going for non-doc, there's ways to show revenue. You know, one way is depositing funds into the bank account prior to applying, right? Low overdrafts, consistent deposits, healthy ending balance, right? 30K plus a month in revenue generated, right? Ideally when you're going for funding. But if you don't have that, at least showing consistent, high enough limits on the personal side, right? So now applying strategy, right? So here's how you guys apply strategically, right? Do not shotgun applications. Don't just start applying randomly. Like start with the local credit unions first that you've built a relationship with, and then you can start to move into the bigger businesses like Chase, Bank of America, and whatnot, right? But start with the small banks that you already have relationships with first. All right, have your documents ready. And use the money wisely, right? Use the debt, pay it back, even if it's 0%. Use that debt and pay it back so that you guys aren't looking like you need the money, right? Once you show one bank you're able to borrow the debt and pay it off, another bank will be more likely to fund to you. All right. Yeah. So that's all I have for you guys for this video. Appreciate you guys for tuning in. If you are a business owner doing 10 to 30K plus a month and you're looking to work with our team to help you throughout this process, even to help you see, what you could potentially qualify for, click the link in the bio and book a call with our team, and let's see if you're a good fit.